this hour, the Federal Reserve officials remain divided on interest rates, with some members seeing the need for more increases, while there were also some others who expected a slowdown in growth to remove the need to tighten further. This even as the decision to increase the benchmark rate by a quarter percentage point was unanimous. And to discuss this further, whether the Fed should hike, should not hike, I'm now joined by Geoff Dennis, independent emerging markets commentator, and Mahantesh Sabarad, independent market expert. Thank you very much, gentlemen, for joining us here on ET Now. First things first, your opening comments.
As far as I'm concerned, it was an extraordinarily difficult meeting, I think, for the Fed to come to any real sense of what they would project for the next meeting. You had disagreement, obviously, on whether inflation was falling rapidly enough or what the economy was doing. But you also had a lot of uncertainty, in particular over the regional banks crisis, which is still, out there, causing some ripples, some days anyway. And of course, above all, on the debt ceiling situation, which is a real major risk for the markets, at least in the very, very near term. So the fact that they didn't give us a clear jump on what they're going to do on interest rates in June is no surprise for me. Plus, of course, you've got more data before then, another inflation report, another payrolls report as well. My call would be a pause at the very least, probably the end of the hiking cycle in May, but a pause certainly in June, and then wait to see how all these various factors pan out.
Right. Mahantesh, what's your first take on the story, your opening comments?
I tend to agree with what Geoff is trying to say. We would probably see the interest rates peaking out from the Fed, and probably this is the time that they will either pause or they will at least announce the last of the rate hikes, which could be just a marginal rate hike of 25 odd bips. Their guidance, if you look at the forward guidance by the Fed, they would reckon that they are already forecasting the inflation to ease off by the time the year 2023 ends, and even by 2024, from a current inflation level of the PC inflation is what they look at, from a current inflation level of 4.2 or thereabouts. Now they are looking at the inflation coming down by as much as a percentage point in the next 12 odd months to 15 odd months. So that being the case, we should be seeing interest rates pause, or if at all, just a minor hike.
Right. Thank you, Mahantesh, for your opening comments. And, I want to really ask here, why does the Fed need to keep hiking? Because there are some which are of the opinion that inflation is unacceptably slow. Inflation degrowth has been unacceptably slow. So why does the Fed need to keep hiking?
I agree. I don't think they should keep hiking. Even if you look at the CPI, which is obviously slightly higher than the inflation number that Mahantesh was mentioning there, CPI is at 4.9 now. My numbers have got the CPI dropping to between 3.5 by mid-year, year on year. And we've got real rates. You contrast that with the UK, say, where interest rates are still sharply negative. And I think there's quite a bit of evidence. It's hard to see at times, but quite a bit of evidence the economy is slowing down. And so I think the whole thing is working. Now, one dilemma they've got and one complication here is that the Fed and the markets appear to be obsessed with the idea that you have to get unemployment up in order to ensure that inflation is on a downward track towards 2% to allow them to start raising rates. Now, the problem I have with that whole analysis, the labor market's clearly changed post-pandemic. Nobody really knows exactly what's going on in the labor market. There are clearly labor shortages in certain sectors, but there is nothing magical about getting unemployment to a given rate to ensure inflation goes down if the Phillips curve is moving around, the relationship between unemployment and inflation. And therefore, for me, what matters is what comes out at the end of the process, not the unemployment rate itself. If we can get inflation down to 2% without any major increase in unemployment, that's a really, really big victory for the Fed. So we got to stop obsessing about the need to get unemployment sharply higher and watch the numbers. And the numbers for me are inflation, and the numbers for me are, of course, wage inflation, and they're all trending in the right direction. This is why I think we're now at the peak of interest rates.
Right, Geoff, I'll ask you to stay on with us here, and I'll come to Mahantesh a little later. But Geoff, I want to understand, when you mention inflation, how soon do you think inflation can be brought under the tolerance band of Fed's 2%?
Well, that's a complex subject as well, frankly, because you may recall I think it's about 4 years ago, pre-pandemic, when the Fed couldn't get inflation up to 2%. However they tried, interest rates are, of course, essentially zero. They changed their target from 2% to about 2%. So do we really want inflation to get down to 2%? That's probably going to take a long time. I would think at best the end of 2024. But to get it below 3 and heading towards 2, I think will probably happen sometime in the first half of 2024. And my view has always been that once you get inflation down sharply, real rates turning positive, and therefore us heading towards, if you like, a 2% rate, it's in sight, it's on the horizon, if you like, then the Fed, I think, can start to ease up and stop tightening interest rates continuously. Also, monetary policy operates with long and variable lags, as we all know. My guess is we will be near 2% sometime mid to second half of 2024. When we actually get to 2% itself, I don't know. That may take longer. But do we need to get to 2%, or do we just need to get somewhere near 2%, frankly?
Right. Mahantesh, I'd like you to weigh in on this. He says that Geoff says that perhaps in the second half of the year, the Fed could be close to the tolerance band of 2%. What's your take?
So frankly, the issue here is indeed about inflation, but then more than the overall inflation or even the PC inflation, wage inflation is something that is worrying the Fed most, because wage inflation rise would directly contribute to a large extent to the underlying inflation that is there in the economy. And the wage inflation trends suggest that for the last 12 months, the wage inflation is actually higher than the headline inflation number on a year-on-year basis. Marginally, though it may be higher, it's an area of concern. So unless that wage inflation starts trending down, and the way that wage inflation can trend down potentially is if the labor shortages, the current full employment, low unemployment situation goes away. So my take is that this is going to be, like Geoff says, a pretty long drawn-out process, perhaps a bit difficult too. But the only silver lining on the horizon is that the US banking crisis is, for the time being, over. The exports are starting to rise, and the commerce and industry loan growth is perhaps now picking up pace, although it is, I would say, a bit moderate, but it is picking up pace. Once that happens, when new capacities start coming in, you will naturally see unemployment starting to grow, wage inflation starting to trend down. That's perhaps where the overall target or the long-term target of 2% can be achieved. But time is something that we'll have to watch. Time is not going to be short. Time is going to be pretty long.
Right, time is going to be pretty long, and we also have the US debt ceiling crisis that still remains unresolved. Both Republicans and Democrats have failed to reach a deal as far as the debt ceiling crisis is concerned. And lastly, most of this is really dependent on the data that will come by. So a close watch indeed on key economic data which comes before the next rate decision that happens on June 14th. On that note, thank you very much, gentlemen, for joining us here on ET Now on India Tonight.
Thank you.